Welcome back to another episode of Retire Right. Per usual, I'm Ryan Wyatt. I'm joined by Ron Wyatt and Nick Lewandowski. All of us are advisors here at the firm, or wealth managers. Nick and Ron are they work together on the investment committee as well. Gentlemen, anything new and exciting in your life?
Everything's going well.
Keeping on.
There you go. Same here. The focus of today's conversation is going to be on dividend investing. And the reason that we want to talk about this is because we feel that a lot of people, when it comes to, thinking about their retirement picture, they want a steady stream of income flowing to them, from their accounts, even when the market's volatile. And I think a lot of people will look at dividend-paying stocks as a way to achieve that. Dividends are just something that a company can or might not pay out to their investors. And what we're going to focus on is the pros of dividend investing, some of the risks or the downsides to focusing too heavily on dividend investing. And what we hope that you'll learn is by the end of the episode, you'll have a clearer understanding as whether focusing, heavily on a dividend focused strategy aligns with your retirement goals and risk tolerance or not. All right. So Nick, I'm going to start with you first. Let's talk about some of the benefits of investing for dividends.
The pros of dividend investing, the first one I want to highlight is essentially what you said in the intro, Ryan. I think the appeal of this dividend investing strategy is fundamentally what you summarized. It's the idea of collecting an income stream without having to touch principal. I think people respond to that very intuitively because they feel like they're getting the income, and everyone likes the idea of not having to sell things that are principal and eat into that. And people, the intuitive understanding, right? It works just like rental real estate or something like that. You have this income stream that comes to you, and you can line that up with what your spending needs are, and it kind of takes care of itself, or it feels like it takes care of itself anyway. The other thing psychologically that I think helps is, because people aren't thinking about the principal and needing to draw on that, if the market goes down, as long as the dividend income stream stays stable, the market downturns don't bother them as much because they feel like, I don't need that principal. I just get the income stream, and it makes everyone feel safer and warmer and fuzzier about the strategy.
So the consistent income stream is
consistent
one.
Income stream. People think that there's principal protection. I think they start to go into that mindset. There is not principal protection, but it feels like there is because they feel like they don't have to touch the principal.
Okay.
Is the other one, and because of that, I think people feel like they're better protected from market volatility by following that strategy. I don't necessarily think that that's true, and Ron will cover that, but that's what people think.
Okay. Any other benefits that are worth highlighting?
Yeah. There's a couple more. So, one of the nice things about dividend investing, as opposed to just owning a portfolio of higher yielding bonds with fixed coupons, assuming it's fixed rate bonds, is that dividend paying stocks tend to have some inflation and growth potential built into them. So you're a little protected from inflation risk. Companies tend to grow their earnings over time, and therefore their dividends tend to increase over time. So, if you buy bond to income invest, and those payments generally aren't increasing with inflation over time, but the dividend paying stocks offer some of that growth potential and inflation protection.
Nick, normally I have to tell Ron to go back and maybe in a less technical manner explain something, but you use the word coupon in there. What? In layman's terms.
Are you talking about going to the grocery store?
Oh, yeah. Coupon.
In layman's terms, coupon.
Yeah. Coupon is just like the interest payment that comes off the bonds.
And then the question I had was, second question I had on what you were saying. So is it safe to say that if a company decides to declare dividends, and let's just say they have a history of consistent dividends, does that then become an objective of theirs to to grow those dividends, and because investors would look at it as like a signal risk that, hey, their dividends are going down?
The textbook answer to this is yes, exactly what you said. It is more nuanced underneath the hood because I don't want to steal Ron's thunder, but when you do a strategy like this, understanding the true sustainability of dividend payouts relative to a company's health is one of the most important things that you have to do. Okay. So just because a company declares a dividend and just because there are these signaling pressures to maintain and increase it over time doesn't mean, one, that they actually intend to do that. Two, that even if they intend to do it, they will be able to do it over time.
Okay.
I'm kind of stealing probably some of Ron's thunder here, but
Please stop.
Okay, so you covered on the consistent income stream, the growth and inflation protection aspect. What about are these dividend stocks? Are they less risky? Are they less volatile than some other stocks?
They tend to be companies that pay out larger dividends with a long track record of doing it. They tend to be more mature businesses that are more stable economically and also that aren't as volatile in terms of their market price. Yeah, that's generally true.
Okay. And then what does this mean for the longer term returns? Like you're getting this income, say maybe you're not taking it out of the portfolio for living needs. Maybe you're kind of redirecting it back to the portfolio. So what could that mean long term?
Yeah, so it depends on what your objective is. Once you're in retirement, if you're primarily concerned with just the income stream and you don't care about the capital appreciation as much, then just collecting all that income is viable. You can still pursue a dividend investing strategy if you want to accumulate more wealth, but at that point, it becomes important to reinvest at least a portion of the dividends that you're receiving. Basically, those dividends then get reinvested in the stock in more shares of the stock, or you could buy other things with the dividends too. And then there's a compounding effect, obviously.
Right. So you're using the dividend income, you're purchasing more shares, assuming that the dividend stays stable or even grows over time.
Correct.
That dividend payout could increase for you.
So you're not necessarily limited to thinking of this as an income strategy.
Sure.
Correct.
Okay.
Yes.
Gotcha. All right. And then Ron, let's switch over to you. Hopefully Nick left some meat on the bone here.
Cut some meat off your bone.
Yeah, he's Mr. Half glass full. I'm half glass empty as it pertains to dividends. But I'm only kidding. There's pros and cons.
So let's talk about the downsides, the cons of dividend investing.
So first of all, there's an opportunity cost. When a company makes money, they have a couple choices what to do with the money. One is, pay out a dividend or maybe buy back stock. The other, they can reinvest in the company. So when you get a company that's paying out a dividend, they may not be growing as much in the future, and so you miss a lot of opportunities just focusing on especially high dividend paying companies.
Okay. What other cons can you think of? I know Nick obviously mentioned income. Income means taxes. So can you talk a little bit about tax impact?
Sure. So if you have a high dividend paying stock in an IRA, 401k, you don't have to worry about taxes. It's not taxed. Think of an IRA as a box. It's not taxed when it's in the box. It's only when the income comes out. But in a taxable account, let's just say that you're 40 or 50 years old, you're trying to grow your money. Dividends are taxed every year. Where a capital appreciation, if you invest $10,000 and it goes to $20,000 and you don't sell a tax efficient vehicle like an exchange traded fund, that appreciation from 10 to 20 is not taxable unless you sell it.
Yeah.
So it's not tax efficient.
Yeah, and a term that you could use for that is called tax drag.
Yes.
The more tax inefficient you are in a taxable account or a non-qualified account, the more that's going to impact your returns. So it's very important to focus on, the structure of your account and making sure that you have tax efficient investments in the accounts where whatever's happening inside them, it's not that box that you described. Everything is taxable. You need to make sure that you're being as tax efficient as possible. This one, I find this one to be interesting because the next downside, because I think that Some people will look at
Oh
one
my
figure,
gosh.
and that's the payout ratio. Like, what is the current dividend yield? And that's a slippery slope. So can you talk about that?
You can call it yield chasing, dividend traps, but I've seen this. I remember when I was very new in the business, I met a doctor who worked for Westinghouse. He had almost his entire portfolio in Westinghouse stock. And I explained to them, textbook reasoning to diversify, right? Concentration, like you're not diversified. What happens if something happens to Westinghouse? And he's like, oh, Westinghouse is a great company. Well, we all know what happened, right? Westinghouse stock price went down drastically. They cut a dividend, and his net worth was pretty much wiped out.
Yep.
And so you don't want to just chase high dividend yields, because a lot of times that's a sign that something's wrong with the company. Now, if you want to pursue a strategy that you have a quality company that's profitable, paying a dividend, a reasonable dividend, and the likelihood that they can sustain that and increase that over time, that's okay. But just chasing yield tends to be very dangerous.
So can you hit on why that's the sign of a struggling company, a high dividend, payout?
So let's just say you have a company trading at 100, and the dividend yield is, say, 2%. Okay. If the price goes down drastically, say from 100 down to 20, the dividend yield all of a sudden increases. If the dividend's the same and the price goes down, the yield increases,
right,
for the future buyer, right?
Right.
But what the market is telling you, when there's a drastic decrease in price from 100 down to 20, the market's basically telling you something's wrong with this company.
Yeah.
And some people are attracted because of that yield, but you have to be very cautious.
Right. So the point there is that the dividend yield does not always signal the the health or strength of a company in terms of is that something you should invest in?
Exactly. Because a lot of times when a company's price goes down that much, the market knows something's happening, and eventually the dividend's cut.
Yeah. And I can relate similar story. When I was working in Virginia, we had a client in our office, ExxonMobil. Tried telling them diversify out of it, wouldn't listen, loved the dividend, loved the payouts. Eventually that turned on them, and it was a sad situation. That kind of leads us into the concentration that you were kind of talking about, like being concentrated in a specific position. Is there anything else that you would want to highlight in that area, or do you feel like you've kind of already captured it using the Westinghouse example?
So the concentration, I think you have to look at it, tends to be high dividend paying stocks are many times in very specific industries. For example, utilities tend to pay higher dividend stocks. You could have certain communication companies like AT&T and Verizon that pay decent dividends. Somewhat consumer staple companies, some pharmaceuticals. So if you focus on a strategy that's very dividend oriented, especially high dividend orientation, you'll miss a lot of technology companies, a lot of quality industrial companies, just a lot of quality companies that you should really have in your portfolio.
Yeah, and concentration, what we mean by that is really just like lack of diversification.
Yes.
You're just focusing your portfolio in a few areas of the market, maybe even less than a few areas of the market, maybe one area of the market. And what happens with that is that, when it comes to investing, there's time periods when, things are in vogue and out of vogue. And it really doesn't matter what it is. It could be, growth stocks are in vogue and, value stocks are not. Utility companies in vogue, they're not. So we just think it's a better approach to diversify, smooth the return, smooth the risk
Exactly.
over time.
Well, I want to highlight real quick before you guys move on, tie this back to your case study stories you gave, because that's one form of concentration, but there's an even more dangerous form of concentration, which is someone I love the dividend yield of this specific stock. They end up owning one or two stocks.
Yeah, kind of like I was saying with Westinghouse.
And then something goes wrong, and you can zero yourself out that way.
Oh, yeah.
Oh, yeah. Think about Westinghouse, General Electric. One time the
Sears
greatest,
paid a big dividend at
Sears,
one time.
Kmart. I mean, we can. There's a list of companies. Xerox back in the day. So many companies that were once dominant get out of favor. The dividend seems very attractive, and then they almost go out of business, if not go out of business.
And I know, Nick, you mentioned this kind of earlier, but with the dividends, they can be an inflation hedge if they're growing, but what if they're not growing?
Yeah, so if you buy companies that are quality, meaning they have good profitability, they pay some out in dividends, they reinvest in the business, kind of sustainable, I think those companies can keep up with inflation. They can increase dividends by inflation, maybe even a little bit more than inflation, which is great. What I want to warn you about is the focusing on very high dividend paying stocks. A lot of times they don't increase their dividends much. They're actually subject to dividend decreases, and they're not necessarily a great inflation hedge.
Schedule your complimentary review with Ryan and his team today. Just visit them online at wyzewealthadvisors.com or call 724-271-7019 to get started. That's 724-271-7019 to get started.
All right, so let's transition the focus into our approach. And I know that the way that we view replacing income is certainly more holistic than just looking at stocks that pay dividends to meet that objective. So Nick, could you maybe speak to what our process looks like and why it is more holistic than just a dividend-focused strategy?
Yeah, and this response isn't a process deep dive. This is just high-level comparison that I'm going to make right now. The dividend strategy we've been talking about is very narrowly focused on only stocks and only stocks that pay enough income that they can, however you put them together, they cover the income need that you've identified. We use this more holistic approach where we think we can obtain better diversification and obtain that income replacement by owning multiple different types of assets within a portfolio. So it's stocks and bonds with different characteristics.
Okay. Now, I guess the question that I would have for you is, everybody I'm sure has heard this before, I don't like bonds. So what do you say to somebody if they don't like bonds for whatever reason, and that's their justification for wanting to use dividend-paying stocks to replace income?
Yeah. So my initial response to I don't like bonds is well, why, you're not going to play golf with them? You're not going to go out to dinner? The idea that you don't like a particular security, to me, is actually hard to get my head around, because different financial instruments, they're just financial instruments with different sets of characteristics. It's just it's like saying I don't like screwdrivers. You either need a hammer or you need a screwdriver. Whether you like them or not doesn't really enter into it. And I think on the bond side, if I was joking a bit there, but if we get a little more serious about it, I do think people have some preconceptions about bonds and their pros and cons, that we have a unique approach to structuring our bond portfolio versus a lot of what's out there that I think would lead people to see bonds and fixed income in a different light. And I'm sure Ron will be happy to elaborate on what that is and the benefits of it.
Yeah, our bond portfolio, the current yield is near 6%, which is very attractive. And that's using about 70% in treasuries.
Which are very, very safe, conservative investments.
Exactly. Different types of treasuries, short-term, intermediate, long, but it's very diversified. And so, especially in today's environment, extremely attractive. So the bond portion is there to give you some stability from the stock market, give you some extra income. The stock part is there to give you some capital appreciation and dividends that are hopefully growing over time. So as Nick said, it's a holistic portfolio. It's a balanced portfolio.
Sure. And is it safe to say that by incorporating bonds into the portfolio to help replace the income in retirement, as compared to even, let's just say, a diversified stock portfolio with a focus on dividend payouts, safe to say that the risk would be lower in the balanced portfolio that includes bonds, even with the higher payout that you described at 6%?
Oh, I think the balanced portfolio would have a lot less risk.
Okay.
And for you to approach the income that the balanced portfolio provides, you'd have to have you'd have to have really, really high dividend paying stocks. And we had already talked about the danger of doing that.
Yeah. So it's a lower risk way of meeting your income needs in retirement is the simplest way. The one thing that I want to hit on is just, again, I don't want to do a deep dive into the process, but once you establish, hey, this is what the mix of like your holistic portfolio that's going to help meet your spending needs in retirement looks like. This is how much you have in stocks and bonds and cash, et cetera. What process or what are we doing to consistently meet that income need while also making sure that the markets aren't, pushing the risk too high or pushing it too low?
We do something called rebalancing, and all it is, say that you have this portfolio of stocks and bonds. You're in the tech bubble. Everyone's really excited. Stock market's very expensive. What most people are doing is they're just buying, they're selling their bonds and they're buying more and more stocks. They're putting on leverage. They're going to only technology stocks. So they're basically buying high. Our system is when an asset class is moving up, getting overweighted compared to where we want it to be, also getting very expensive, we trim that asset class and go to other asset classes that are probably underperforming, but they're still solid asset classes and on a relative basis getting cheaper. So what we're basically doing is selling high, buying low in a systematic, very disciplined way.
Yeah.
And to take it a step further, global financial crisis, the opposite thing happened, right? So here you had stocks going down tremendously and bonds going up. And so systematically what we were doing is trimming bonds as they were, the price was going higher, the yield was going lower, trimming that, buying stocks that are cheaper. And so what it does for you, this process, is helps with risk tremendously, and it can also help with return.
Nick, let's go ahead and put a bow on this. So total return versus the income return. What's the more important one to look at? And I guess maybe just explain like the difference.
Yeah, we would say total return. So the difference is if you're just looking at income, you're essentially just looking at the yield that a portfolio or an asset produces. Total return looks at the ability of that asset to appreciate in price, right, capital appreciation, plus whatever income or yield it generates. And I think our perspective has probably come through in this conversation is that this holistic approach is better. I mean, we can generate the same income need that a dividend investing strategy can generate, if not more in some cases. And we can do it with more diversification,
or
which
less risk.
Decreases risk, like just there's a straightforward relationship there. So in my mind, it's almost like, why would you want to narrowly focus on dividend-paying stocks when we can get the same or better result without as much concentration as risk in the dividend strategy?
I think that's a perfect way to end it. And just want to make a quick note here for our clients. We appreciate you guys just coming in to the meetings and asking the questions that you do, because ultimately, as I had mentioned, way back when we were first starting the podcast, those questions that you ask ultimately fuel our ideas for future episodes. So please continue to do that. As I've always said, please never hesitate. If you have a question, reach out to me directly. We'll break it down on a future episode. Any ideas you have, etc. So we hope you enjoyed, and thanks for tuning in.
This episode's content is for informational purposes only. Opinions expressed herein are solely those of Wyze Wealth Advisors, unless otherwise specifically cited. Material presented is believed to be from reliable sources, and no representations are made by our firm as to other parties' informational accuracy or completeness. All information or ideas provided should be discussed in detail with an advisor, accountant, or legal counsel prior to implementation.